This video presents key insights inspired by Graham's original advice, showing you how to become an intelligent investor yourself. First principle. Intelligent investors avoid rushing into decisions. They take the time needed to thoughtfully evaluate a company's long-term value. While substantial profits are possible, the risk of loss is evident. Finance history offers numerous instances of investors, like Warren Buffett, who earned massive returns by investing in sound companies. Similarly, there are many cautionary tales of individuals who made poor investment choices and faced significant losses. Thus, we must reflect: is investing truly worth the risk? The answer is yes, as long as you employ the intelligent investing strategy. Intelligent investors rely on comprehensive analyses to secure reliable and consistent returns, unlike speculators who chase short-term profits driven by market volatility. Speculation is inherently risky since no one can predict future trends. For example, a speculator might act on a rumor about Apple introducing a popular new product, buying large quantities of Apple stock. If fortunate, they could profit. However, if the rumor fails, they risk substantial loss. In contrast, intelligent investors prioritize pricing. They only purchase stocks when the price falls below their intrinsic value, specifically relating to a company's growth potential. An intelligent investor seeks a margin of safety, akin to shopping. An expensive dress is worth it only if you intend to keep it long-term. If it's of poor quality, it's better to choose a more affordable option that lasts. The life of an intelligent investor may lack excitement, but the focus on profit makes it worthwhile. Second principle. Intelligent investing encompasses three essential tenets. First, intelligent investors assess the long-term development and business fundamentals of potential investments before buying stocks. A stock's long-term value is directly tied to the company's performance. Therefore, it's crucial to analyze a company's financial health, managerial quality, and dividend payments, which distribute profits to investors. Avoid the trap of focusing solely on short-term earnings. Instead, look at the overall picture by reviewing the company's financial history. This analysis offers insight into the company's operational success beyond current market value. For instance, a company might lack popularity and thus have a low stock price. However, if it has consistently generated profits, it could be undervalued, offering a solid investment opportunity. Second, intelligent investors mitigate significant losses through diversification. Never invest all your capital into a single stock, no matter how promising it appears. Imagine the shock if a once promising company ends up in a tax fraud scandal. Your investment value could plummet instantly, leading to irreversible losses. Diversification ensures that you don't lose everything simultaneously. Finally, intelligent investors recognize they won't achieve extraordinary profits but rather safe, steady gains. The goal is to meet personal financial needs, not outshine professional Wall Street brokers. Competing against those who trade for a living isn't practical, and fast profits can foster greed and carelessness. Third principle. Intelligent investors appreciate the significance of stock market history. Before investing, it's crucial to study the general stock market's history, not just individual stock performances. Historical analysis reveals that the stock market experiences regular fluctuations. Many of these changes are unpredictable, so investors must prepare financially and psychologically. Economic crises, like the Wall Street crash of 1929, are recurring realities. Ensure you can withstand such hits, meaning diversifying your stock portfolio protects your investments from simultaneous downturns. Mental preparedness for crises is vital. Don't panic and sell everything at the first sign of trouble. Remember, the market always recovers after significant crashes. While predicting every downturn is impossible, studying stock market history aids in understanding its overall stability. Once you establish the market's steadiness, shift your focus to the companies you wish to invest in. Fourth principle. Avoid following the crowd or market whims. To grasp market behavior, one can envision the stock market as a person. Let's call him Mr. Market. Mr. Market is unpredictable, emotional, and often misguided. His mood swings reflect in the stock prices, fluctuating between unwarranted optimism and unjustified pessimism. For instance, with the launch of a new iPhone, excitement can lead to inflated stock prices due to overzealous buying. In periods of vulnerability, stocks may drop in value despite hints of impending growth. Intelligent investors must be realists and resist following trends. When Mr. Market is euphoric, he may mislead you to see non-existent profit opportunities. Just because a stock is currently profitable doesn't guarantee its future success. In fact, consistently performing stocks often face downturns when demand inflates prices to unsustainable levels. Recognizing patterns is our nature, but psychological biases may lead us to perceive fictitious trends. The following sections will delve into practical investment tips tailored to your individual investing style. Fifth principle. The defensive investor's portfolio should be balanced, secure, and manageable. At the beginning of your investment journey, choose a strategy that aligns with your personal characteristics. Decide whether you're a defensive or enterprising investor, focusing first on the defensive investor. Defensive investors prioritize safety and integrate diversification into their investments. This includes allocating money to both high-grade bonds, such as AAA-rated government securities, and common stocks, which grant voting rights in critical business decisions. A balanced split of 50-50 between these two is ideal. For risk-averse investors, a 75% bond to 25% stock ratio is acceptable. Stocks offer higher rewards but come with risk, while bonds are more stable, albeit yielding lower profits. Sixth principle. Investing becomes seamless when you adhere to a structured formula. Once you finalize your target investments, take a moment to congratulate yourself. Most of the hard work is done. Next, decide how much you wish to invest regularly and check your stocks periodically. This process, known as formula investing, involves following a set routine for your investments. This is termed dollar cost averaging, where you consistently invest a fixed amount, monthly or quarterly, into a common stock. After identifying a secure investment, automate your contributions. Begin with a fixed allocation, such as $50, invested at regular intervals. Acquire as many shares as possible within your budget. This method reduces risk and prevents the temptation to gamble. While formula investing simplifies processes, emotional challenges may arise. Despite the temptation to capitalize on low stock prices, stay diligent to your preset limit. Periodically reviewing your portfolio is essential. A good practice is to reassess your stock and bond ratio every 6 months. Seek guidance from a professional once annually to adjust your investments effectively. With these straightforward guidelines, prosperity will reward your prudence in due time. Seventh principle. Enterprising investors often start with the same principles as defensive investors. To excel in enterprising investing, adhere to many strategies used by defensive investors. Both types of investors divide funds between bonds and stocks. The enterprising investor often opts for higher equity investment, seeking higher rewards at greater risks. Consulting a financial planner remains essential. However, enterprising investors approach the planner as a partner rather than a mentor, collaborating on decisions. In addition to bonds and stocks, enterprising investors explore riskier stocks with potential for higher rewards. For instance, you may hear about a promising startup that is rumored to be the next Google. It's an opportunity, but cap your investment in these speculative ventures to a maximum of 10% of your entire portfolio. Intelligent investors should remember to stay cautious. Market unpredictability might lead to irrational investments. Consistently researching and monitoring portfolios is crucial for maintaining profitability. Eighth principle. Enterprising investors resist trading based on market trends. If stock prices drop, do you sell immediately or hold? If a stock rises, should you invest before it's too late? This tendency, known as reactive trading, arises from fear of losses. An intelligent investor, however, understands the dangers of following Mr. Market blindly. Rapid stock price increases may indicate overvaluation or a risky investment. Remember the housing bubble? Everyone invested heavily, ignoring inflated prices. When the bubble burst, the market crashed dramatically. To prevent such pitfalls, enterprising investors buy stocks at low prices and sell during high markets. Regular portfolio assessments are necessary. Scrutinize the management and financial health of companies you invested in. If you determine a stock is overpriced and deviates from its true value, sell before it declines further. For instance, Yahoo Incorporated capitalized on the opportunity in 2002 by acquiring Inktoy Corporation shares for a mere $1.65 each after prices fell significantly. Ninth principle. Enterprising investors have the unique opportunity to identify genuine bargains. While becoming an enterprising investor sounds enticing, you might wonder if the effort is justified. It is because the greatest bargains are unveiled through persistent portfolio monitoring. Begin by practicing virtual investing for a year to sharpen your stock-picking skills. Many platforms offer this, allowing you to see if your investments yield above-average results. This annual period serves multiple purposes, honing investment strategies while managing expectations. Once you have navigated virtual trading successfully, you're prepared to find valuable investments. Look for undervalued stocks. Market sentiment may temporarily devalue companies facing economic challenges. For example, if Enterprise B, a major competitor in the refrigerator market, experiences profit loss due to a production error, its stock price could drop heavily, even though its performance record remains solid. Once that issue resolves, it will likely rebound, and a savvy investor will view the falling prices as an opportunity instead. However, identifying these bargains takes effort, further emphasizing the importance of your year of practice. If you can thrive in virtual investing, you'll likely succeed in the reality of stock trading. You've just absorbed essential insights from Benjamin Graham's The Intelligent Investor. Whether your approach is defensive or enterprising, always strive to walk the intelligent investor's path. By adhering to the guidelines presented here, you can transform your investments into steady, modest profits.